Welcome to Allied Title and another edition of Boring Title. Today I'm extremely excited to have John Downs with MVB Mortgage. John has been in the industry for a long time, one of the most successful top producers in the area. Really excited to have you here today.
Yeah, thank you. I'm hopefully not going to make this as boring as the title.
Hey, there's no doubt title insurance is the most boring thing of all time, so we're looking for fun people like yourself. So first of all, I heard someone say recently that you will manage someone's stuff for a lifetime. I don't know what it's about. I mean, you're very different than other people I've met and kind of how you run your business. Tell us a little bit about that.
Yeah, so in order to explain it, I have to give you a little background. So I've been doing this for 19 years. In the first 10 years, I was really just what I would call today's modern loan officer. And a modern day loan officer is you call them and say, I want to, can I? And that person says yes, and here's what it costs. Mm-hmm. And it's in its simplest form, that's what it is. Your credit's your credit, your income's your income, your cash is your cash. You put all that stuff into a computer and it says, here's your rate. Hit another couple buttons and it says, and the computer approves you. And I laugh and joke that my 8 and 10-year-old daughters can actually do that really well by now. So in 2009 through 2011-12, I became a counselor, a life counselor, mostly because I witnessed and experienced a tremendous number of families that went through crazy hardship in the downturn. Short sales, foreclosures, divorces as a result of financial trouble, problems with their children as a result of the financial trouble, as a result of them moving into areas where maybe they couldn't get in the best school districts, and just lives unraveled as a result of the financial decisions that people made. So that wound up leaving a mark in me to do things different. So I finally said, what I realized looking back is I think mortgage lenders tend to be the first person that people wind up meeting where they talk openly about finances, their finances, investing, future goals, because that is what I think real loan officers need to do, right? So you want to buy a house, but then what does that mean over the next 5 or 10 years? Is this your house that'll serve 5 or 10 years? Are you just going to move out in 4 to 7? Are you dating anyone? Are you going to get married soon? Are you planning on having any kids? Are you going to keep this as a rental? So that morphed into this idea or this concept of being a mortgage planner. So if you think of your financial advisor manages your finances and your investments, so I basically look at that debt, the mortgage debt, and find ways to manage that for you forever. Sometimes that means strategic refinancing. For instance, right now, you guys are crazy busy. As boring as title is, it hasn't been boring over the last couple months. But really, we've been refinancing almost everybody that bought a house and took a loan from late April last year all the way till November of last year, right? So that whole window of time, people were able to refinance their mortgages, save roughly 0.5%, and in many cases do it for free. So if you think about that only lasted for about 2 weeks. Yeah. So by the time the average consumer, well, I don't know if people read the paper anymore, but let's just assume they read the paper. By the time they saw the average rate, it was 2 weeks old. Yeah. And they kind of missed it. As they started thinking, oh, maybe I should refinance, rates picked right back up again. Just enough to sort of squash their opportunity. So in my role, we just have a lot of technology, CRM systems where we monitor current rates, current values, and then we constantly monitor current dynamics to make sure that you're always in the best loan for that period of your life, right? Sometimes that means shortening it to a 15-year loan. Sometimes it means educating people to buy an investment property so that they can have cash flow for when their kids go to college. Or maybe that's their second 529 plan is a piece of real estate that grows in equity, and then that equity can help subsidize their college expenses. So I don't know if that helped answer your question.
That's great. I think you're looking at it as a lifetime and how to help them make best decisions. Whereas a lot of times people just say, rates are low, let me reach out. You're actually thinking about it with them. You're reaching out to them. I mean, you definitely are, managing more than most loan officers I've ever heard of.
Yeah, and then the other part to that you said, right? So people call and they have a need. The need is rates are low, I want to refinance. So it's funny when I look at this last cycle, how many people I talked out of refinancing. So, and some people would look at me and be, that's silly. They called you and they wanted to refinance, but it didn't make financial sense. When you looked at how much they would save to the transaction costs to how long they plan on living or keeping that property, if all that stuff doesn't work, the advice should be no, don't do it. Wait, let's set up some triggers. Let's figure out where it does make sense. And I think that's the part that's missing in much of the financial industry right now. That it is for the most part, a sales-driven culture to satisfy the needs of the consumer. And if a consumer has a need or a desire to refinance, then just fulfill it, give them the answer, and refinance. Versus push back and say, maybe this isn't the right thing for you to do right now, and here's why.
Yeah, absolutely. And, I think the other thing, you and I were talking earlier, you've been reading, you're always up and reading insider stuff that's happening in the industry, in the market, where trends going. And everyone I hear is like, oh, rates are going to go up. Guaranteed, rates are going to go up, whatever. You had told me about some kind of blog you were a part of where there was actually an article on reasons why rates actually might go down in the coming years. You want to kind of talk about that? And just, who knows what will happen with the philosophy behind it?
Right. It's so the biggest hot button that we have right now is you hear all this talk about a pending recession. And at the same time, rates can't stay low forever. So before I get into the next part, just Google Japan's 10-year bond rates. You'll see they've been at zero for like 3 decades. So rates can stay low for a long, long time, and they can actually get a lot lower, right? Look at where German yields are right now. So this is the longest economic expansion that we've had in quite some time. There is not a tremendous amount of inflation out there. And if you sort of take a graph, there was something in the Wall Street Journal about 2 weeks ago, and it basically overlaid the unemployment rate to the recessions. And what you'll see is once unemployment hits a long-term bottom, the recession's right after it. So when you have recessions, ultimately what happens is, and it's not all bad, right? So we're in the DC, Northern Virginia market, and the recession was caused by housing in 2009 and 10. So housing recessions are bad for housing. Regular recessions tend to be really bullish for housing, and mostly because interest rates drop because of the money transfer. Everyone's going to sell all their equities because that might get chopped in half like it did in 2009, and then they plow all that money into mortgage bonds, which drives down rates. So during that cycle, that's when everyone restructures their debt. So for instance, some of the people we said no to recently, like don't do it yet, this conversation became important. Why pay $3,000 or $4,000 in transaction costs if maybe you're going to do this 18 months from now anyway? Right? So I think, broadly speaking, in our local market, we are lucky to be in an area where we thrive on things that are not tied to consumer spending and manufacturing. Right? So think of the whole Midwest, maybe that's where the recessions are. But on the coasts, they might actually thrive because debt might get really cheap. And all those people squeezed out of housing can actually get in. And then all those people with houses can refinance and save $400, $500, $600 a month that can then be reallocated to vacations and cars and other investments. So it'll be an interesting time, I think. Right now, the industry is basically saying bracketed second half of next year around the presidential election with maybe peak uncertainty might drive some business confusion, and maybe that's when we see pretty good rates. They're already really good, right? Yeah. But they might actually touch all-time lows again, is what a lot of people think.
That's awesome. So busy market, a lot of multiple offers going on. What are you guys doing with your team to kind of make sure people are winning? Kind of talk. I know you guys get stuff turned around very quickly on your end, but tell us a little bit more about what you guys are focused on.
So right now, the general trend. So anyone out there thinking of writing a contract, the idea is you have to think about what the seller wants, right? So obviously the seller wants the most money. First and foremost, they kind of want the most money, but they also want the safest contract. And sometimes safety means getting my money, if I'm the seller, in my bank account faster, right? If I can get my money in 2 weeks, that is safer than getting my money in 3 or 4 weeks. So speed is a big thing. I think most of the good quality lenders in the area, any real estate agent will probably name 4 or 5 companies. They're usually sort of like your small boutique private. MVB is one of them, and we're known to just zip things through in 2 weeks. All that said, I think there are a lot of people out there who are writing these really aggressive contracts without truly knowing consequences. So if you said, what is the one thing that maybe I'm doing quite a bit different right now, is I'm a big educator. And I like everyone knowing what the risk is of doing certain things. As an example, we had a client the other day where they waived all contingencies, financing, appraisal, home inspection, right? And you're probably seeing that on all the contracts, or there's nothing to them. So but the problem is they didn't really know what they were doing, right? What if the property appraised 5% low? What if it appraised 10% low? You know, how does your finances, your financial package change with your mortgage? So the one thing where I probably excel the most is educating through all the what ifs to then provide comfort with that aggressive offer, so that when you win, you're 100% confident in every outcome and the experience is awesome, instead of the tremendous amount of doubt that pops up and the what ifs and the oh my's, and then when that one thing happens, you're like, oh, I never thought this was possible. So I always say that my role, or a good lender's role, is to make sure that as you go into anything, you know 100% of all potential outcomes, and that you're comfortable with all of them. And I think in this market, that's way more important, because the winner does have to write a pretty buttoned up contract, close quick, waive contingencies.
Absolutely. Well, hey, thank you so much for coming. We really appreciate it. It's great to work with you as always.
Yeah, no problem.
Thanks for your time.
Thank you so much.